Buying an annuity means locking your hard-earned retirement savings into a rigid contract for the next decade. Yet most people accept the very first quote they receive from a single, captive agent without questioning what else is out there. That single quote doesn't represent the broader market. It only reflects one company's interpretation of your retirement needs, restricted entirely to their limited inventory of products. You wouldn't buy a house or choose a surgeon based on one isolated opinion, but every day, retirees make irreversible financial commitments doing exactly that. This checklist outlines what we call the annuity blind spot, critical data deliberately left out of standard marketing materials, like market comparisons, hidden fee drag, and payout factor analysis. Diversified Insurance Brokers acts as an independent diagnostic clinic. With access to over 100 highly rated carriers, we perform an objective second opinion on your existing quote. Skipping a second opinion frequently results in trading away optimized financial security for the sake of simple convenience. When you shop for annuities, high percentage upfront premium bonuses are the first thing that catch your eye. They look like free money added straight to your account. But there is a catch. Many of these massive bonuses apply exclusively to the contract's income base, not your actual accessible cash value. The income base is an accounting phantom to calculate payouts, not real cash you can withdraw or pass to heirs. To get it, the contract timeline stretches, locking you into longer surrender periods. You also suffer lower cap rates and watch annual rider fees balloon. We X-ray these specific contract mechanics to find out if a bonus actually drives real value for your retirement, or if it's just a marketing tactic driving a fast sale. Chasing a headline bonus without understanding its classification traps your nest egg in a rigid, expensive contract that ultimately yields less net income. When we shift our focus to fixed indexed annuities, the details get even more complex, driven by hidden rider fees and specific carrier payout factors. Two annuities that look nearly identical on a summary page can produce drastically different lifetime income amounts over a 20-year retirement. This data table illustrates a stress test, comparing a single carrier quote against our optimized alternative. Look at guaranteed annual income. The original offers $24,000, while the optimized alternative delivers $31,500. Notice the annual rider cost drops from 1.2% to 0.85%. This gap compounds into $75,000 of additional income over a 10-year retirement. We execute this exact stress test against over 100 carriers to guarantee the payout factor is mathematically maximized for your specific situation. Failing to compare top-rated carriers means quietly bleeding thousands of dollars in hidden fees while willingly missing out on tens of thousands in guaranteed payouts. Even with a straightforward product like a single premium immediate annuity, or SPIA, buyers are rarely shown the subtle structural choices that dictate their costs. The most critical choice is your payout frequency, taking your income as a single annual lump sum versus receiving 12 monthly payouts. Assuming a single annual payment is cost-effective is flawed. To generate the exact same yield, an annual payout requires a significantly larger upfront premium. Because the company guarantees a massive single distribution, their actuarial cost increases, and they pass that cost to you. In contrast, monthly payouts divide that burden. The frequent, smaller distributions drastically reduce the total premium required to hit your income goal. Our team actively models these structural tweaks side by side, helping you hit your exact income targets using the absolute least amount of premium possible. Maximizing every premium dollar requires aligning internal mechanics and payout frequency with your specific cash flow needs, rather than focusing only on a headline rate. Annuities are highly powerful financial tools, but only when their internal mechanics perfectly align with your specific mission. If you are an accumulator looking for safe growth, a second opinion protects you from being shoehorned into high-fee, liquidity-trapped income products you don't actually need. If you are an income seeker, you must optimize those specific carrier payout factors, or you risk leaving massive amounts of cash flow on the table. As this decision tree illustrates, certain warning signs mandate an immediate review. Holding a quote from a single captive agent, being pitched a massive bonus, or nearing the end of an existing surrender period. Diversified Insurance Brokers provides this independent review at zero cost. It takes minimal time and creates absolutely no sales obligation. It is a guaranteed win for your portfolio. Either the review validates your current quote for total peace of mind, or it uncovers a mathematically superior alternative. Securing a second opinion from diversified insurance brokers is the single most critical step in transforming an annuity purchase from a blind leap of faith into an optimized, evidence-based retirement strategy.